Hi, good evening to all the esteemed clients and colleagues who've joined us today for this exclusive webinar on the Abakkus Flexi-cap Fund. It gives me pleasure to welcome all of you and thank you for making the time. As you all know, Abakkus is a marquee asset management company managing more than $5.5 billion worth of assets through their PMS and AIF strategies. Abakkus has come up recently with their first equity strategy on the mutual fund platform, which is the Abakkus Flexi-cap Fund. It's my pleasure to have Vaibhav Chugh, who's the Chief Executive Officer of Abakkus AMC with us today, and he'll be deliberating in detail about the strategy, about the fund, and about the markets. Just to give a quick introduction, Vaibhav obviously has a rich experience of more than 25 years in the financial sector as well as in investments. He has a rich experience across asset management companies, including marquee names like White Oak Asset Management, IDBI AMC, ICICI Prudential AMC, as well as Franklin Templeton. Welcome, Vaibhav, and we look forward to hearing from you on markets. How do you see the markets in the light of recent developments, and you just give us a detailed flavor of the flexi-cap strategy from the stable of Abakkus. So without further ado, I request Vaibhav to take up and give us a detailed insight with respect to the markets as well as the strategy. Vaibhav, over to you.
Sure. Thank you. Thank you so much, Siddharth, and the entire Kotak Securities team for giving us this opportunity to interact with all of you. We are quite excited, like Siddharth said, that we have launched our first maiden NFO on equity side, which is our Abakkus Flexi Cap Fund. Before I get into the product and our views on markets and our fund management style, I'll quickly try to introduce the group to you. Abakkus Group, like Siddharth very rightly said, that is a renowned name. We started our journey in 2018 with AIF, and over last 8 years, we have evolved and we have offered, various products in the alternate space, AIF, PMS. We have UCITS. As we speak, we also have private equity funds, and we also manage couple of foreign mandates. So all in all, we manage about 40,000 crore of assets, and this entire 40,000 crores are primarily invested in Indian equities. So therefore, from that standpoint, we are one of the largest equity fund managers, and we do only and only investment management. As you would see, even on the screen, that the only work which we do is around investment management, and we don't have any other interest. So that's the pedigree of the group. This group was founded by Mr. Sunil Singhania, who is our founder. He started Abakkus in 2018 after spending about 2.5 decades with various firms, mostly with the Reliance Mutual Fund, which is currently called Nippon Mutual Fund. He was the chief investment officer, and the fund, the most known fund which he used to manage was Reliance Growth Fund, which now is called Nippon Growth. In fact, that was a fund which multiplied the NAV by 100 times. That was the first fund, rather, in the entire country to multiply NAV by 100 times. And 10 rupees product became 1,000, and I think currently is about 4,000 odd. Now, what is more important here is that 10 rupees becoming 4,000, it means 23% compounding over last 30 years. And last 30 years, all of you would agree that markets have seen so many swings. We have seen so many Black Mondays, Black Tuesdays. We saw subprime crisis. We saw taper tantrum. We saw IT crash. We saw September 11. We saw COVID and so many others. Despite of so many drawdowns on and off, the fund delivered a compounding return of 23%. Also, if you deep dive, what I also want to emphasize is that this 30-year journey would have also seen many cycles. Many times economy goes through cycle. Many times capital markets go through cycles. Many times stocks, sector, everything goes through cycle. So if somebody has managed money for so many years and have been privy to so many cycles, that experience is really, really worthwhile. In fact, the team which Sunil has made at Abakkus Group is also quite seasoned. As we speak, we have 25 people in our investment team, and the 25 people put together, the total experience of these people is about 450 years. So imagine the collective wisdom of 450 years. Uh, Managing your money will definitely give some edge in terms of experience which they bring to the table, the knowledge which they bring to the table, and of course the varied exposure of various and varied sectors definitely adds that extra edge in the fund management space. So that is what the group is all about. We are a backers mutual fund. Like I said, that we have been doing all alternates, UCITS, private equity, and so on. In August of 2025, just about 3-4 months back, we also received the mutual fund license to take our expertise to even retail MNI and HNI investors through our mutual funds. So mutual fund is quite young, but like I have mentioned on the screen that we are a young AMC, but with decades of experience. Of course, our guiding force, Mr. Sunil Singhania, and the entire investment team in mutual fund or at Abakkus Group are they are quite experienced. So therefore, we are from mutual fund parlance, we are a very young AMC, but we come with decades of experience. And one of the most important thing for any group, any company, any firm, any individual, one of the reason why somebody does well is if a company or if fund management style or if investors, if you and me, if we follow a process in our life, the chances are that we will make lesser mistakes. See, all of you must have heard about various cycles. You would have also heard and read about emotions. Ultimately, all of us are human beings, including the fund managers, and any human being can have any kind of emotion. It can be fear, it can be greed, it can be fear of missing out, and so on and so forth. So, if a fund manager who is also a human being, if you don't have any processes and philosophies in place, it may so happen that a fund manager may get swayed by any of the biases or any of the emotions. Like for example, you must have heard that if a fund is not doing well for whatever reason, and if there is no control in terms of philosophies and processes, it may so happen that to catch up returns with other fund houses or other fund managers, the fund manager of A may do, he may try to get into momentum, he may try to get into what is doing well of late, and that in itself can lead to some uh, uh, I would say disasters, or maybe something which is not conducive for forthcoming returns or the future returns. Now, like I said, that even fund managers are emotional, are human beings, and they may also have emotions. They may also have biases. How do we overcome biases? Is by having a defined investment philosophy and the framework in which the fund manager has to operate. So at Abacus, we have our investment philosophy, which is defined for last 8 years, and all the fund managers operate in this defined philosophy. One, it is very clear to our fund managers that our responsibility is to generate alpha. Second, we don't make money by betting on where interest rates are going, what is happening with inflation, what is happening with oil, any macroeconomic event, any macro news. We are only and only bottom up investors, and we don't take any top down calls. We don't position our portfolios keeping in mind that interest rates are going up, you start buying banks. If interest rates are going down, you start buying consumption stocks. That is all what we don't do. We are pure and pure bottom up investors. At the same time, we are very clear that a great company may not be a good stock. So if you overpay, uh, uh, you know, so for example, if I find a very good company whose value is 100 rupees, even if the company is very good, but their intrinsic value is 100, and if I am trying to buy that company at 98 or 102, you would understand that the money which I will make, even in that great company, will not be good because the value of that company is already explored. So we are very clear that we will never overpay for a good company, and we are cognizant of the fact that a great company may not be a good stock. because of the price at which that stock is available. Fourth, we are quite agile and flexible. It means that, though we do deep research and we try to find good companies for our investors, but it may so happen that some of the hypotheses may not work. Some of fundamental issues may crop up in any company. In that case, we will be quite agile and flexible and nimble enough to admit, sell, and move on to maybe some other good company. We are not those kind of investors who would say that I have found this company, I will not sell this stock till the time I do not make money. If we have found a company and there is some hypothesis which has gone wrong, or if there is some fundamental deterioration, then we will be very happy to cut losses and move on. And however, we invest in any company keeping in mind that we will be partners and we will not churn unnecessarily. One quarter results are not good, two quarter results are not good, will not be our reason to sell off. If one quarter result is not good, but business is doing well and business potential still holds very, very good, then there's no unnecessary reasons for us to sell and churn our portfolios. We look at companies to be a partner and probably would like to invest for pretty long. And we are happy to be contrarian, which means that, like I said, that we have a deep research. We have 25 people in our research team, and we are reaching out to even small companies to find out which all companies can fit our investment philosophies and may do well. There might be cases because of our, very deep research. There might be many companies where no other fund manager has explored or no other research company have explored. But we find that company good. We'll be happy to be only and the first investor in those kind of companies. We don't take any momentum call. Like I said, that if some other fund is doing well because of XYZ reason, we will not jump into that reason just to catch up with the returns. That's not our style. We'll be happy with our own research. We'll be happy with what price we pay, and therefore we will not take any top-down calls. We will not chase momentum. We will not try to mimic others, and therefore we are quite fundamental, quite balance sheet driven, quite numbers driven organization. Even if you look at our tagline, it also says believe in the basics, because we firmly believe that if a company is growing, if the earnings are growing, the stock will make money. Of course, you have to check that what price you are paying for that. And then, there are 6,000 companies listed in India. We first do the understanding, the filtration of looking at every company and see which all company fits our philosophy. About 1,500 companies fit into our philosophy, which I just explained. In those 1,500 companies, we again run a filter called MEETS framework. Now, MEETS framework is our framework wherein we try to filter out companies which, according to us, should do well. And that filtration is called MEETS framework. I'll just spend a minute to tell you that how did MEETS framework come into existence. When Mr. Sunil Singhania started the organization, he got all the fund managers together and told that please write down which all mistakes you have done in life. And if we know what mistakes not to repeat, the probability of doing better, the probability of doing consistently well really goes up. Of course, human beings or even fund managers may make new mistakes. There is no doubt about that. But if you don't repeat mistakes, then probability of doing better than others is quite high. Repeating mistakes will be like a disaster or a blunder, and therefore it is very important to be aware of what to do and what not to do. So therefore the MEETS framework came into existence. Now all the 1,500 companies, we take them through this filter called MEETS framework, and we take them through all the levers which are there on the screen. Now M stands for management. We look at companies where the management is very strong, and I am aware that many of you would think that everyone tells we buy in companies where management is good. What we are saying is that we have defined what is management. According to us, a management which is capable of doing right capital allocation, or if we are able to make more money out of their capital by investing in businesses or expanding their businesses, which can increase ROEs, are the managements which we like. So we have clearly defined that one, the management should be nimble enough. They should not be flamboyant. At the same time, they should know how to use capital. And if the management is increasing return on equity or return on capital, we like those kind of managements. The second, we look at earnings. And earnings, like I said some time back, that ultimately stock market is like pendulum. It moves across two extremes. But ultimately, what is called mean reversion, which you may have heard many times, ultimately stock market come back to the middle point, and that middle point is nothing but the earnings growth. If it is quite, if the markets have really gone up, it will mean revert to the center point, which is earnings. If it is quite negative and the earnings are high, it will again swing back to earnings. So we understand that ultimately returns will be made on earnings. But at the same time, what we look at in companies is that the companies which can grow more than the nominal GDP, if your GDP is growing by say 7%, 8%, and your inflation is another 3-4%, the nominal GDP is about 11, 12. If a company is growing more than 11, 12%, are good companies according to us. So we will filter out companies where the average earning growth is more than 14, 15%, which means that their earnings can double in 4 years, are the kind of companies which we like if we are comparing 2 or 3 different companies, and we would like to invest in companies which are at least they have capability to double their earnings in 3 to 4 years or 5 years. So that's the earning lever. Third lever which you look at is the events and trend. It simply means that you may find a very good company which was doing well, the management is strong, even earnings was good, but we may also encounter companies which are doing well. However, the trends or the situation of that sector is that the future returns may diminish. Now, let me give you an example. If you find a very good newspaper company, with due respect to them, now you and me, we know that company may be very good, but one of the major source of their revenue, which is advertising, that is shifting elsewhere. It is going to social media. People are not investing as much as in newspaper when it comes to advertising. That all is moving elsewhere. Now, if you have to find a company, you also need to keep in mind that what are the future events and trends which may be conducive or which may not be conducive for the company. So we keep an eye on that. If you recall, a couple of years back, Asian Paint was again doing very well. It's a great company, but with advent of new competition via Birla Opus, and JSW also lost their own uh, paint brand. So there were some trends around Asian Paint that the future market share was kind of looking diminishing. So you have to be cognizant of that in terms of where you want to invest, what are the environment or the events or the trend, are they conducive for that company or the sector or not. The fourth lever which you look at is called timing. Again, it is not about timing in the market. It is not about timing the market, sorry. It is about what price you are paying today. So if there is something called market price, there is something called value. Now, if you are giving price and not trying to buy value, you will underperform or outperform. So if you are buying price because company is very good, versus you are trying to buy a company at a price where the value is still to be captured, of course, in the second case, people will make more money. So we are quite clear that a great company may not be a good stock, and the price which you pay will make you incremental return. But if you are investing in exploring the entire value of a company, you will create wealth. So there is a difference between incremental return and there is a difference between wealth. According to us, wealth is created when you don't overpay. And fourth, of course, you also have to keep in mind that your portfolio should be future ready. When I say future ready, it simply means that ultimately you and me, we will do well because our country is doing well. Let me give you one anecdote, and I've been asking this many investors for many years, that Warren Buffett became Warren Buffett not only because of his style of investing. One of the main reason why Warren Buffett became Warren Buffett was because America was growing. If America was not growing, Or imagine if he was born not in America, but say in a Pakistan or in a Bhutan or in a Cambodia, he would have never become Warren Buffett. One of the reason why Warren Buffett became Warren Buffett was because America grew. When America grew, there were companies which were growing because of America doing well. And because there were companies which were growing because America could do well, was doing well, he bought those companies and became what he is today. Now, in India, if you have to look at, we are also that kind of a story. All of us will do well because India will do well. Uh, like when we became $1 trillion as an economy, we became 1 trillion because of certain industries, jute, cotton, steel, coal, etc. From 1 trillion to 4 trillion, we moved up because of, IT services, insurance, private banks, and so on. From 4 to 8 trillion, we may grow not because of the sector which I said. It may be very, very new sector. It may be consumption, it may be tourism, it may be lifestyle. We don't know. But we know that the growth which will happen from 4 to 8 will be for very different sectors. So if your portfolios are not positioned keeping in mind how structurally India will evolve, then you may also underperform. So therefore, at Abakkus, we also keep in mind that, are the companies which we are identifying, are they future ready or not? Are they aligned to the structural changes which is going around us or not? So our investment philosophy, we extract about 1,500 companies, and in that we run our entire mates philosophy, and the total uh, universe which we manage is about 450 stocks, which is the research of Abakkus, and we also take some research from outside, which is another 250. So in all, we have about 650, 700 stocks, which is part of our universe. And that is what makes Abakkus a little different from the others, because, our universe, thanks to our universe, we are able to explore a lot of uncharted territories, lot of undiscovered companies and undiscovered sectors. So that's our entire investment process, that we look at universe, we bring the filter of needs, and then we do our research once again in terms of meeting the management, doing the entire financial modeling, and then the portfolio is made. So it's an extensive work which goes behind, thanks to the large investment team which we have. I have already spoken about this, that we are very clear what we don't do. We don't chase momentum. We will never churn unnecessarily. We'll never copy and mimic. Will not have any biases, so to say. And we stay away from balance sheets which are already broken, because it is very impossible for them to recover. For paucity of time, I'll quickly move to flexi cap. See, if you look at total mutual fund industry is about 80 lakh crore. In that 80 lakh crore, about 50 lakh crore is equity. And in that 50 lakh crore, the major proportion of money which is there is in the flexi cap category. Now, basically, SEBI has defined flexi cap as a category which can maneuver between large, mid, and small cap, keeping in mind the view of the fund house or the fund manager. However, with due respect to all the fund houses, nowhere I'm saying that any fund is good or other fund is bad, etc. But what I'm trying to now going to position is that, in the existing flexi cap categories, wherein the SEBI has defined the contours, like I said, that fund manager can maneuver between all market caps. Apparently, what has happened is that most of the flexi cap funds currently are large cap biased, or they are large cap oriented. It can be by virtue of size, or it can be virtue of the changes in reclassification which happened over last 5, 6, or 7 years. Because of which, I mean, I don't know the reason. It may be because of size, it may be because of market conditions, it may be because of classification. But in the cohort of flexi caps, all the flexi caps are currently large cap oriented, with average large cap exposure at about 60, and average number of stocks are about 62. Now, let me explain this in terms of one table. The funds which are above 1 lakh crore in flexi cap, their average large cap exposure is 95%, which includes cash, and their total number of securities are close to 158. Similarly, if you look at the band of 75,000 to 1 lakh crore, all the fund houses, all the flexi cap funds in this range have large cap exposure to the tune of 87, 50 to 75 are 76, and 25 to 50 are 65. I am reiterating, not that these funds are not good, these funds are doing pretty well, and I'm sure they will do well. But what we believe is that there is a chance which can be given to a fund house like Abakkus, which is going to be a true to label flexi cap, because our endeavor is to create a product wherein our large cap exposures will be in the range of 40-45% or thereabout. Our mid and small cap exposure will be about 50 to 55%. The portfolio which we want to manage is, we will have about 45 number of stocks or thereabout. So therefore, you will find a very good balance between large cap holdings. You will find a very good balance of high conviction ideas, and that fine balance will make it a true to label flexi cap product compared to all the flexi cap products which are there in the market. So we are positioning our fund to all of you that within flexi cap you can diversify into one of the flexi cap funds, which is not like industry average of large cap oriented. It is a fine balance between mid and small cap and large cap. I would also like to reiterate one more point, that we have also put internal guardrails in place. Guardrails means the investment committee has defined contours of for the fund manager to operate. One, what we are saying is that per large cap exposures cannot be more than 9% per security. Mid cap per security, the fund manager cannot go more than 5%. Small cap, the fund manager cannot go more than 3% per scrip. And the top three sectors in the market, the deviation allowed is 30%. Now, the idea of creating this, these contours of 5% mid cap maximum per stock, 3% maximum per small cap, 9% per large cap, 30% deviation in the top three sectors is also defined, keeping in mind that we don't want to hug the index. We also want to have liquid stocks, and we also want to have high conviction ideas from Abakkus Group. So therefore, by doing this, we will create a product which will have a very fine balance of large cap to the tune of about 45% or thereabout, and 50 to 55% in small cap. And also, I spoke about the fact that we have a large universe to explore. By virtue of that, what will also happen, which you will see eventually, is that the active share or the active weights of the fund will be in the range of about 65%. Thus, the overlaps will be low compared to even the industry. Last thing which I want to share with all of you is that we are also cognizant of the fact that, if, like I said some time back, that if you have a lot of biases in the portfolio, till the time that biases or that factor is doing well, you will be topping the charts. But as and when that bias or that factor goes out of the trend, then the oscillation is such that you will also come at the bottom. So when you create a portfolio which is quite factor diversified and which is quite biases diversified, the oscillations or the volatility is automatically reduced. Now, one way, to also mitigate risk or to mitigate volatility is by also keeping in mind that, if you look at the sectors in the market, there will be a lot of sectors which will be positively correlated, and there will be a lot of sectors which will be negatively correlated. Now, for example, if I create a portfolio of 10 sectors and say 6 sectors are positively correlated, if there is something which may go wrong with one of the sectors, some news or whatever, and your 6 sectors are correlated, the swings will be much higher versus a fund where this correlation is, say, only 2 or 3 sectors. And that is again, part of our portfolio construction, that we will create portfolio of flexi cap in a way that we want to minimize correlation. We need to have good balance of large cap, small and mid cap, because that's where like they say कि जितना आप इंडेक्स से दूर जाओगे उतना आप alpha और बना सकते हो. Now, you also need to have a fine balance of finding companies which will do well. They may be very small, they may be mid, but at the same time, you also need to have right balance of large cap to ensure that there is enough liquidity, there is cushion in the portfolio. And third, you will also keep in mind the sectoral correlation to minimize the volatility. And fourth, which I said that in our portfolio construction, we have also put internal guardrails that small cap will not be more than 3% per security, 5% per security on mid cap, and 9% on large cap. Top three sector allocation will be the deviation allowed is 30%. So that is how our flexi cap fund is going to be positioned. It's a great category. Funds in flexi cap across the industry are doing well, and they will do well. Not that I'm trying to say that none of them is doing well because they are large cap oriented. My only request to all of you is to look at Abakkus as one of another allocation within flexi cap, wherein the style diversification will happen because of what I just explained while I was talking about the product. Uh, Another thing which I wanted to share, of course, is on the market, which even Siddharth mentioned about. So, see, our view on markets is quite constructive. Uh, so there are two or three angles why I say there are two or three reasons why I'm personally also quite optimistic about markets. There are two main or maybe three main levers. One geopolitical, second, of course, the tariff thing. Let me first talk about geopolitical. So, all the geopolitical issues which were there till about 6 months back, 1 year back, are seemingly fading away. There are, one or two nuances, one or two news which keep coming, but by and large, most of the geopolitical news have dried. It could be India, Pakistan, it could be Thailand, Cambodia, it could be Russia, Ukraine, it could be Israel, and Middle East. So I think most of those things are behind us. Of course, chutput news aati rehti hai, but by and large, those are quite settled. Second, tariff, of course, that's one of the risks which still lingers on. But our sense is that entire world tariffs have come down to 15 odd percent. It should not happen that India will remain at 50. Our sense, we are quite optimistic that even if it may take 1 month or 2 months or thereabout, but tariff things should also get resolved. I think India is also working quite hard in terms of negotiating. But yes, that as we speak, still is a concern, which was a concern some time back. But we'll see how things evolve. According to us, it should get resolved to about 15 odd percent. And it is not about it will happen or not. It is, I think, now more to do when it will happen. So that's the thing which we have to see. Uh, Third, the most important thing, if you go back to September 24, when the last peak was formed, and if you recollect all the negative news which were that time spoken about, we were talking about markets at high and earnings at low. Today, the reverse is happening. Markets are at low and earnings have started looking better. This year, earnings may come back to about 9-10%. And next year, we will again bounce back to 14-15% earning growth. So that time, your earnings were looking negative or 1%, 2%, but your markets were at peak. And therefore, FIs were also quite pessimistic on our valuations. And even a lot of Indian economists were also saying that we are overpaying. So that has become ekdam ulta. Matlab markets have corrected. There's a time correction, and earnings have now started coming back. So one of the biggest reason why markets fell in September 24 is behind us. Second, from that date to now, our interest rates have come down by 125 basis point. Our liquidity is much better. Government capex that time post election had gone down. I think government capex has come back, and even private capex has also started picking up. Private consumption has started picking up. We have already seen GST cuts. We may also see pay commission coming in. The monsoons have been pretty good. So the levers of markets or economy are quite positive. Even if you look at our current account deficit, our trade deficit, all those are looking much better. So I think fundamentally we have come a long way from September 24 till now. But of course, till the time tariff thing doesn't get resolved, there might be, or we may require one trigger in form of, tariff thing. But according to me, like I said sometime back also, ultimately markets reward earnings. The earnings are now coming back, but markets have been subdued. So therefore, from that parlance, I think it is a very good time to start looking at equities again, and maybe give 3, 4, 5 years, we should do well. Last but not the least, see, even in the market space, it is very important to look at that what is changing around us. So what is changing around us, and I'm sure all of you will agree with me, is on mainly on 2 or 3 things. One, the per capita income is going up. Now, what happens with per capita income going up is that a lot of new sector evolves, a lot of new consumption trends evolve, and lot of these smaller companies, they start getting bigger because you and me, we need them. Like 10, 15 years back, we used to go to a restaurant only when there was a birthday or anniversary. Today, Zomato delivers every day. I think every week in every household. It is changing because we are getting busier, we are getting more money, and therefore we are okay to spend money. For office, we wear different shoes. For running, we wear different shoes. For gym, we wear different shoes. For malls, we wear different shoes. Same family, same person, probably used to have 1 or 2 shoes, will now have 5 or 6 different kind of shoes. Uh, Tourism is going up. People are spending more in uh, Indigo flights to buy those cookies and all than the number of pizzas which are sold at the ground. All this is nothing but consumption. We have Louis Vuitton available in India. We have Apple opening their store. We have all brand which we used to hear, which were only available outside India, are currently available in most of the cities. This is nothing but per capita income story which is coming, and I think that will lead to a lot of new companies, a lot of smaller companies to come. Of course, there is a trend around technology, renewable energy, all that, EMS on the manufacturing side, all these things, is something which will take India to next level. So therefore, it is also important to build your portfolio, which is more forward looking, which is more future ready. And I think, and that is where the deep research of any fund house, which has the capability to research deep dive, will be able to create portfolios which will have, this blend of being future ready. At the same time, those companies will be like mid and small. So therefore, that research will be required for us to start taking exposure in those kind of companies. But it is important that we have the fine balance, even in our portfolios. At your end, I'm saying, in your portfolio, you should have a very fine balance of what is evolving, what will evolve, how are you and me spending money, how the consumption of power, energy will evolve, uh, how will tech uh, turn around, what will happen in the manufacturing side. All these are very, very interesting spaces where most of the companies are small, but they will all become quite big. So, from market parlance, it is also very important to keep in mind that markets will also do well because a lot of these new things will evolve. And I think that in itself is also great opportunity to create wealth. Markets have spoken that, we are quite positive. I think most of the negatives are behind us. And earnings coming back gives us a lot of comfort. I'm sure, even US has started cutting rates, so you may see FII flow also to come back. I think because of FII outflow over last couple of years, or 1.5, 2 years in specific, we have also seen pressure on rupee. But I think with very good reserves in our pocket of $693 billion, quite quite decent current account deficit. I mean, during taper tantrum and those periods, our current account deficit used to be about 4%, and some outflow of FI used to give a big dent on our currency, which doesn't happen today. Our import bills are well taken care of because of the the reserves we have. Our current account deficit is about 1.5%. So I think even from rupee parlance, we are not that much bothered. But yeah, tariff thing is something which we are looking at. I think budget is very early to comment on, but should be very conducive for economies. But let's wait and watch how does that evolve. I think from portfolio point of view, not that my NFO is going on. Even my NFO was not there. I would have sincerely asked everyone to start looking at markets because markets have corrected. Time correction ho chuka hai. Earnings have started looking better this year. Next year even look better. So markets will mean revert. And I think if you are able to find good companies, you should do well in terms of your portfolios also. So that is what I wanted to share. Thank you once again for listening very patiently to me. Siddharth, back to you.
Thank you so much, Vaibhav. I think detailed insights from you, both on the market and on the fund. You obviously spoke about how the flexi cap is supposed to be a true to label fund and will have allocation across the market cap cycle, across large mid as well as small cap companies. So a question, and I'm preempting on behalf of clients, I believe we have gotten a couple of questions. One obviously is that how do you leverage your PMS AIF strengths and experience on the mutual fund side? So that's the first question. And the second, obviously, is how do you differentiate this fund from your peers? And third question, I'm preempting on behalf of clients. You covered the market in detail, and you said obviously the earning visibility is back. There is, from a macro perspective, we're in a very good shape, both from a current account deficit perspective. I think GDP numbers have been attractive. However, and inflation has been relatively low. And then we have seen the 125 basis points, rate cuts as well. So the economy is in good shape. However, does the rupee slide and the fact that FIs continue to be sellers in the Indian market worry you? So that is another question on the market side. And then the two questions that the clients have posed on the YouTube, links.
Sure. So I'll first come on the PMS AIF learning. Of course, our journey has been very, very decent there. If you look at our mid cap strategies, they have outperformed the benchmark index by 12%. Our all cap, I mean, our diversified strategies have outperformed the larger index by about 7.5% over last 5 years. So that speaks very well in terms of how we have done. How will we leverage? See, our research is common across the group. All 25 people are common across the group. So therefore, this pool of 450 companies is common. Of course, the strategies in terms of execution will be very different. So PMS AI fund managers are separate, dealers are separate, mutual fund managers and dealers are separate. They will not get to see each other's portfolio. But of course, in mutual fund and even in PMS AF, it also depends on the product strategy, which may differ. So our sense is that the universe is common, but the way we look at stock or the way we approach stock investing, that is similar across the group. Our DNA of investment management, like I spoke about philosophy, I spoke about framework, all that is common across the group. So by that parlance, the experience on PMSAF has been quite good for our investors, and we hope that we will do well even on the mutual fund side. Sorry, I missed the other question on the markets you said.
So the question on the markets was that, with the rupee obviously sliding down to historical lows from a dollar perspective, and the bearing on that obviously on the markets being that FIs will probably continue to sell in the short term. How do you see that from a market perspective, and how can an investor position their portfolios in the medium to long term perspective, looking at this scenario?
Sure. So that's a good question. Thanks for that, Siddharth. See, my sense is that FIA outflow to a large extent has also been compensated by the domestic flows. And I think domestic flows will continue because, our SAP books have gone up, Indian aspirations have gone up, people have started understanding the difference between savings and investing. And because they understand investing well, a lot of money has started coming to capital markets. I think that should continue for quite long because India is in the transition from developing to developed. And for us to become developed, you need to have per capita of $20,000. I think in that the wealth creation through capital markets also play pivotal role. So I don't think domestic flows will go down, and therefore that comfort is there that FIs, even if they go out, there is a cushion coming from elsewhere. However, my personal sense is that now FIs should also come back. Like I said, in September they moved out because there were a lot of concerns on valuations. Markets were at peak. We were the best performing emerging market and lowest in earnings. Today, we are the worst performing emerging market with quite decent earnings. So there is a reason for them to come back. That time, America was doing exceedingly well because of AI fancy. The four AI stocks had made more wealth than entire world put together. So there was fancy of AI, and therefore a lot of money went there. In 2026, my sense is that that fancy will also kind of slow down. Once that fancy slows down and India market starts doing well, a lot of money will come back to emerging markets. And because we have not done well, that will become one of the reason why we will attract flows. Of course, China will also do quite well in terms of FII flow. But I think if China is the best in terms of FII flow, we may be the second best to get the flows. So my sense is that FII flow will come back to India. It went out, like I said, because Indian markets were at the peak with lowest earnings, and that has reversed. And even on America side, we are also seeing rate cuts happening. Uh, if AI fancy goes down, the money has to move elsewhere. Third, Siddharth, I'm sure you will agree with me that people only look at FII flow, but we also forget that there is something called FDI flows, which also reflects how the foreign world is positive or negative on India. And FDI flow per se has not diminished. It has actually been doing quite well. We have heard a lot of banks getting billions of dollars. Even Muthoot is getting big FDI flow. RBL is getting a lot of FDI flows. So we also need to keep in mind that as a country, if there were a lot of problems, even FDI money would not come. But FDI money is still coming in, which I think reflects that as an economy, we are still one of the preferred one. They were not happy with the valuation, and today they are happy with the valuation. So FII will also come back, and FDI flow anyhow is coming to Indian markets, which I think is very, very conducive, so to say, if you were to talk about fundamental strength of any country. So for me, FII flow is not a concern. I think 2016, 2026, we should get flows back. Emerging markets should get the flows back, and we should also get our pie.
So I think last question from our side, I think Vaibhav, do you see the yen carry trade to be a challenge for the markets, or do you see that as a non-event?
Aji, we were chatting with Sunil Singhani ji the other day, and jokingly told कि वैभव ये येन ट्रेड का प्रॉब्लम कहाँ है. हमने बोला जापान में. तो बोला जापान मार्केट इज एट टॉप 27% रिटर्न एंड वी आर एट नेगेटिव. तो जहां प्रॉब्लम है उधर markets are doing well, why should we worry? So the point which he was making was that one, if yen carry trade has to happen, I think most of those things are already absorbed by the market. We as a country, anyhow, we have lost a lot of 15, $16 billion we have already lost. So I don't think it will give a long negative to us. There might be some knee-jerk reaction because people would like to know how the impact will be. But I think after knee-jerk reaction, everyone will understand that that is more specific to Japan rather than your own economy. And like I said, I mean, I've been part of market for 25 years, and I'm sure you are also quite experienced. Ultimately, only one thing sustains, and that is earning. Come what may, there might be drawdowns for 1 month, 2 months, 3 months, 1 year, 2 year. Ultimately, if earnings is doing well, money will be made. So I think we in India, we should, rather than focusing on yen carry trade, we should focus on where are earnings coming back. Be present in those sectors, stocks, and you will do well.
Perfect, Vaibhav. So I think the key takeaways are that the economy is in a great shape. Earnings coming back, markets should look strong from here on. And you obviously have a true to label flexi-cap product, which is currently on, and the last day for the NFO is 22nd. Thank you so much for the insights, and thank you for making the time,
Thank you for
especially to all the
inviting me.
clients on the call and all the colleagues. Thank you so much. Thanks, Vaibhav.
Thank you, Siddharth. Thanks for inviting.
Thank you.